People want to know the difference between cash and accrual accounting. Accrual accounting tries to capture what really happened. It creates an invoice when you earn the money and recognizes the revenue at that time. And it creates a bill when you've incurred an expense and recognizes that expense at the time of the bill. Cash accounting recognizes revenue when you collect the money and recognize an expense when you pay the bill. So they should, from the beginning to end of a business, you should end up with the same total result. But from a time period stamp, if I billed something in February but didn't collect it till March, in an accrual system it would be revenue in February. In a cash system it would be revenue in March when I collected it. On a bill, let's say I have an accounting bill. I like people to get used to paying accounting bills. Let's say I have an accounting bill and I bill you for some of my services in December. You receive that bill in December, but you don't pay me until January. If you're in an accrual business, you would be able to deduct that expense on your December books. But if you're a cash business, you couldn't deduct it until you were on your January books. One thought on this is credit cards. Credit cards are considered an open line of credit. And so credit card expenses are actually deductible when you charge the credit card, not when you pay the credit card bill. So that's one way for a cash basis taxpayer to accelerate his deduction if he doesn't have the cash. He's basically borrowing money from the credit card company to pay it now. Go back to the thought of cash versus accrual. QuickBooks and your accounting programs are typically set up to be accrual basis accounting. And I've always told my clients, manage your business by accrual because you're getting a better picture of what's going on and you'll manage your business better. Small business and my business is different. We live by the cash. We have to have the cash flow or we're out of business. I compare cash flow to blood flowing in your body. You need cash flow to be healthy, but it's not the only thing that tells you you're healthy. The accrual is like an x-ray. It shows you everything, whether it's flowing or not. So you manage your business by accrual, you live by the cash. The IRS has rules on certain businesses that are required to be accrual and those that are allowed to be cash. For instance, the typical example is a retail store that sells shirts. They have an inventory. Buying more inventory doesn't create an expense. They match the sale of the shirt to the cost of the shirt when it's sold. So if you are selling a product that is inventoriable, whether or not you maintain an inventory, you're required to be on an accrual basis, at least to the extent of the revenue and cost of goods sold. Businesses that are allowed to be cash basis are basically service businesses. My accounting firm is a cash basis business, a lawyer, a dentist, a plumber, an electrician. So you can, in your first year return, you elect the basis that you're filing your return on, whether it's accrual or cash. And once you make that election, you basically can't change it without IRS permission. IRS permission is automatic to go from cash to accrual. It is not automatic to go from accrual to cash.